Welcome to the March Wealth Advisory Review. I'm laughing because I'm having a hard time getting everything to function like it's supposed to. Technology's been a challenge here these last couple of weeks. All right, welcome to the March Wealth Advisory Review, where we're going to take time to look at the markets, the economy, and I'm going to share with you some ideas for how we're going to look at investment strategies going forward the rest of this year. As I've been sharing for the last couple of months, we're going to continue on that same discussion and expand on how we do things different here at Frank Reynolds and Company. Okay, there we go. As always, we have a responsibility to share with you the disclosures that identify that not every investment or every strategy or every idea, including tax and legal strategies, are for each client. Some work well for one situation, but not for another. So as always, we encourage you to take the information that you received tonight, look at it in terms of your situation, maybe involve other professionals in the conversation to make sure that what we're doing with you and what you're doing for your own family situation makes the most sense, has the best value for you. We will have time for questions and answers, either through, you can raise your hand or through the chat box, and you can type your questions in, and I will definitely take time to make sure that your questions get answered. Tonight, we're going to be looking at the market and economic review, what we see happening now and what we're watching for in the future. I'm going to talk in more detail about 5 of the 10 investment allocation strategies that we use. Your cash reserve needs, your income and growth ratio, probability versus surety investment strategies, investment tax management planning, and your risk tolerance investment solutions. As well as I'll share some final thoughts when we're done, answer questions, and then remind you of what we've got coming up next. So let's start with taking a look at the market. The market has continued to have a pronounced growth and experience. Let's take a look. I'm going to pull up the actual market data for that on the S&P 500. Looking at it last month when we were reviewing, it was right about in this area here where we had dropped and then gone back up. And after our last Wealth Advisory Review, you can see the market has continued to move on up. As a matter of fact, if we go back to the high of last July, and last year was a pretty good year for the market, we can see that by December, we had passed that and we have done nothing but go up since then. A few minor adjustments along the way, but it's been a very nice upward trend. I know that there is a lot of information out there right now, and I understand that as I was sharing with you in the last, I'm laughing because we're having a hard time getting the tech to work like I want. I shared with you in the last advisory review about how different biases impact clients' thinking and investors' behavior, confirmation bias, political bias, number of different pieces that I covered in that. And I've talked with people lately who, because the market is high, they're feeling that they have to get out of it, which may be right. I'm not saying that it's not going to go back down, but there are issues that make me think that this has some legs to keep going for a while. We've talked about how the Magnificent Seven has performed in previous advisory reviews, and it has continued to do so. We've talked about various tech companies and how they're driving a significant portion of the S&P 500. And so quite honestly right now, when we look at this upward trend, while there is a reality that sooner or later it will go back down, I don't know that the data supports that happening anytime soon. Obviously, as we get through April and May, we move into summer. Summer tends to be a more flat period for the markets. Depending on what could happen with some of the conflicts around the world or potential conflicts around the world, we could see some issues to be aware of. But having said that, when I look at the trend of the market here, when I look at how its relative strength indicator is significantly above the 50 percentile, when I look at the short moving average convergence divergence, that makes me have a great deal of confidence at this point as well. Maybe if this starts to turn back down, I might see some different points that might concern me. But at this point, Even looking back last year where we saw that happen, it turned out not to be a significant issue because of other factors in the economy. And then obviously there's a huge separation between the daily activity, the 50-day moving average, and the 200-day moving average. That separation gives me a lot of confidence that we're on a trajectory that's going to last this way for a while. Again, though, as I've often shared with you, each monthly advisory review, we share the information about the markets and the economy, what we think is happening and what we think could be next. And if anything were to change in between our regular monthly advisory review, we would have a special review just to bring people up to speed on what we're seeing happen and why we think something traumatic or catastrophic could be at hand. But until that time comes, I would say enjoy the spring and plan for the future. And let's look forward with hope, cautiously, about where we're headed with the economy at the current time. Again, there's talk about interest rates being brought down by the Fed. We are in an election year, which has historically been good for the markets. All these pieces together caused me to see more blue sky at this point than cloudy sky. And so we're going to continue to hold our course with this. We have had a few clients in earlier this year who got a little more aggressive than what they had been previously. 2023 gave them some confidence. We still have a lot of investors, a lot of clients who are still holding back on being aggressive. And we've had a few who've said, hey, I want to get a little more conservative, which we've made adjustments in those portfolios as well. If you are of a mind that you want to get more aggressive or become more conservative, please reach out to us, let us know. My goal will not be to talk you in or out of it, but to share information so that you can make an informed decision what you want to do. And then we can take action appropriately for your situation and your needs. So with that, that's going to conclude what I have to say, at least for today, on the market issues. And we will continue on with the rest of the advisory review, if the technology permits, which it looks like it is. Woohoo, praise God. So you have seen this chart many times before, and at times I've shared pieces of it. But as we finish up the last part of our spring planning season and we move into the investment insurance review season, I wanted to share with you in more detail about 5 of these 10 items. And next month, I'll share about the remaining 5 and how we use these to help accomplish clients' goals. Again, as a refresher for this, the first 4 months of the year are where we do a spring planning. All of our planning clients come in, we re-up their information and repopulate their data for any changes they may have. And then we move from those first 4 months in spring planning. Then the second 4 months are focused on investment insurance review, investments that are held with us, investments that are held outside of us, insurance with us and outside of us, just to make sure that their investment and insurance tools are meeting their planning goals. And then the last 4 months of the year is focused on their estate and tax planning strategies. Tax current year and making sure we've minimized that, tax for future planning to make sure we're not looking at huge tax bills down the road and we can do everything possible to minimize that, as well as estate design and beneficiary review to make sure that their estate plan is well founded, not just for the transfer of assets, but also for taxes, fees, and expenses to minimize those, and to make sure the beneficiary designations for their plan matches the way their current accounts are set up so there's no difficulty in that transitional process. So for now, I'm going to spend a few minutes talking about the 5 items: your cash reserve needs, your income to growth ratio, your probability and surety planning, your tax management strategies, and risk tolerance, and what these mean to us. Keeping in mind that the whole purpose of our planning process is 2 things. 1, diversification with your needs in mind, and 2, being proactive wherever possible and reactive whenever necessary. So let's take a look here at the first piece of this, which is your capital reserve needs. And it really starts at the beginning of the year with this question right here. What are your cash reserve needs for the next 12 months? What we try to do with clients is help them identify what they think they need to have in cash reserve, whether that's 3 months or 6 months or more liquidity available to help with either opportunities or emergencies, and to be able to have that money available to them to meet those needs over the next 12 months. Obviously, things can change, and we might have planned at the beginning of the year for one thing and have to make an adjustment later in the year. But we do try to get clients to think through, what do I need in liquidity for the next 12 months or so? The importance of this really makes it so that two things can happen. One is we can identify what our savings, so those monies which are going to earn less, will be available for clients, and then the rest can be applied to investments. Those investments could be short-term, mid-term, or long-term investment strategies. They could also be set up to provide for goals that are specific on, say, a short-term or mid-term model, or maybe a specific need on a long-term model, or maybe an unspecific need like retirement, for instance, where we don't know how long we're going to need that money. We just plan to make sure the money lasts as long as you do. But the difference between savings and investment would be that we would have money that's quick, liquid, easily accessible in your savings, and the rest could be invested in longer term models based upon the needs for it. What's the goal? Well, so as I've shared with you in the past, the goal for savings is capital depletion. And what I mean by that is simply this. People have money set aside in savings, and an emergency happens, they're able to access that money. If they didn't have that money set aside in savings, they may have to borrow to get some money, or they may have to do something else, sell something that they wouldn't want to sell. So the goal of that money is either for emergencies or opportunities to spend it, to deplete the capital. If it turns out in a particular year you don't have to, congratulations, that's fine too. But the idea of having short-term savings is to make it so you have it available if you have a need. When it comes to short and mid-term and certain long-term goals, the answer is the same. If you have a short-term goal to purchase a car, say in the next 2 to 3 years, well, that's a short-term goal. That goal itself would be to save up money to purchase that car. And then at that point, when it comes time to buy the car, you spend the money that was in that bucket for that goal. You deplete the capital. Same thing's true with a midterm goal, maybe a longer goal of, say, 2 to 5 years, 5 or 6 years. And then long term, anything longer than 6, 7 years, certainly we're looking at long term for many things like college education, etc. That would be to spend that money as well. Not that you have to spend all of it, but if you had to, that was the plan. The only place for capital retention, this last section down here, this last issue here, is for retirement, because we need to retain the capital to make sure you have capital and income to meet your needs throughout life. So one of the first things we try to do with clients, especially from a planning model, is say, what are your cash reserve needs for the next 12 months? At some level, that seems intuitively obvious, but I can tell you it's surprising how often investors or advisors are just trying to invest money and they don't really stop to think about what are the cash reserve needs to make sure that money's available. So that's a pretty simple thing, but it quite honestly is a very important piece that needs to be considered early on in our planning process for each year. The second item is your income to growth ratio. And what this is not is saying, how much am I going to have conservative and how much am I going to have as aggressive for my investment style. Your income to growth ratio is simply interested in one question. What are your income needs for the next 12 months from your investment portfolio? Now, if you are still working and you don't need income from your investment portfolio, then your income to growth ratio is zero. You have everything in growth. We'll talk about your risk tolerance in a moment. But your income to growth ratio is simply an answer to, well, I'm going to need some income this year, X number of thousands of dollars per month or quarter or whatever. I need that money to survive. Maybe I have retired, or maybe I'm approaching retirement. I'm going to do a partial retirement. Your income to growth ratio is not a risk model. It is an income model. And as you've heard me talk before, what we try to do is set over here the resources that you need to meet your income goals. And then over here, that means we can invest the rest of this to meet your risk goals, your long-term reward goals. So we call this your tactical income, and we call this your strategic growth, or Strat Grow and Tact Inc. for short term, or for short explanation. Okay, this is what I was saying a moment ago, is that going back here to July, we see that the market's done, the S&P 500, done a pretty good job. It actually took until about December 5th, 7th, somewhere in there for it to take off. And then after that, it's just taken off. and we've had a very nice upward trend. When I was talking about relative strength indicator, RSI, that's up here, strong, strong. Short moving average convergence divergence, also very strong, well above the median. So that leads me to believe that the economy, and more specifically the technicals of the market, should be good. All right, so I've shared that. Again, if you have questions, I'll be more than happy to go through that. As I had said before, this is a chart that you have seen before. Let me turn this on. This is a chart you've seen before where we talk about the 8 investment strategies or options we use and the 10 investment strategies. And we're going to be covering these 5 here. And then I shared I'm going to set this up as it is because I was talking about it. So the goal is, what are your cash reserve needs for emergencies or opportunities in the next 12 months? Savings, we want to make sure we have that money available for you. And as part of our planning, spring planning, we try to get with each client and say, what do you think you're going to need? Obviously, things can change, but if we have a good plan in place and you say, well, I think this is what we're going to need for emergencies or opportunities, our goal is to make sure we have that set. And the most important part of that is this, that we want to make sure that the rest of your assets can be invested according to your risk tolerance, your longer term goals, meeting your investment needs for short, mid, and long-term strategies. So that's what I was referring to there, and talking about capital depletion versus capital retention. Okay, we talked about your income to growth ratio, which is where I was just finishing up. Our goal with this is to know what your income to growth needs are, not your risk tolerance, growth and income, not that, more specifically your income needs right here, what your income needs are, and then what we have to do to make sure that happens. I'm going to show you more about that. So we're able to leave your money that is going to generate your income for the next number of years in this bucket, and then this money can stay invested according to your risk tolerance. And whenever we have 5% or better returns in a given year, we're able to move money over here to replenish this bucket to keep it able to produce your income for 3, 5, 7 years, whatever it is you have set that for. To illustrate that, let me do this with you. This is sort of a working example of what we might do with a customer. So the client has assets under management, that's investments with us, of $650,000. They have assets held away, be it a 401k plan or a bank or something else, of $425,000. Maybe they have investment real estate that's either growth or income oriented at $375,000. Maybe they own a business and that business is worth $750,000. And then this account right here, the Tact Inc. account, this is $300,000. We've moved from this portfolio over to here to meet their income needs. That leaves us roughly $1.9 million in this particular situation to meet a client's growth and longer term needs. But that also makes it so we can take this $300,000 and use this to meet the client's income needs. Now, what are the client's income needs? Well, they have a monthly income goal of $5,000 a month, and they want to make sure that they have that money set aside to meet those needs. So if we take 5,000 times 12, that would be 60,000 for 1 year cash. That money we'd want to have in very safe interest-bearing accounts that could generate out that $5,000 every month. From the $300,000 up here, that leaves us with $240,000 that we can invest in short-term but higher-paying investments internally in the accounts, whether those would be bonds or flexible income funds or interval funds. Those would be items that we could use to set aside. And then every year, they would receive their income each month, and then we would move another $60,000 over here to then be able to pay the income again. And then anytime we had performance over here that exceeded that 5% performance, we would then take and replenish this. So I'll show you an example in a second, but let's just say that at the end of the first year, we pulled out the $60,000. That means now the account's $60,000 less, but we had really good performance over here. So we just pop another $60,000 over here to meet the longer term needs. Let's say that for whatever reason, the market went down for 2 years and we didn't have that. So we certainly have easily with this amount here, we easily have 2 years or $120,000 of income. And in the third year, the growth strat account does really well. And so then in the third year, we replenish the 2 years that are missing. That way we can keep the $5,000 plus interest with each exceeding year to make it so the clients can have confidence they've got income coming in, and we're not subject to the whims and the ups and downs of the market over in our growth strat portfolio. How does that work over here? Well, so anytime that we have growth, then we replenish. If we have growth, we replenish. If we have a downturn year, we don't replenish. We let the income account pay the income out. And we don't worry about moving money over because we don't want to sell it while it's down. We don't want to empty the account out while it's reduced in value. And then we have another good year. We then make that exchange or replenish as well. And as you can tell here, looking at the various years, say 2003 would have replenished. 2005 would not have replenished because it's under 5%. Even though it's positive, it's under 5%. 2006 replenish, 07 and 08 do not replenish, 09 replenish, 10 replenish, 11 do not replenish, 12 replenish, etc. And you can see how it works. This is our way to make sure that clients can have peace of mind and invest the remainder of their assets at their risk tolerance and know that they've got income coming in for X number of years, knowing that we can withstand a couple of years of bad market and still meet their longer term investment goals, or specifically their income goals. This is how we handle the income to growth ratio. And that's why, as one of our strategies, it's critical, especially for those who are drawing income out, that they have a good plan in place to know exactly how we're going to make each year work in a way that meets their needs. Probability versus surety. I've shown you this particular chart, I think both months for the last 2 months, because it's very interesting how the experts gave their estimates, but the actual performance was either significantly under or significantly over the expert viewpoint. Makes me feel good because I don't always get it right either. Matter of fact, I would say it's very tough to get it right. You can look year over year, 14% overestimate, 15% underestimate, 14% underestimate, and that was in a good year. This was as well. 26% underestimate, another good year, 21% overestimate, and then 17% underestimate as well. So thinking about how to offset that for clients, we have two concepts here. Probability, how likely something is to happen. Many events can't be predicted with total certainty, and that would apply to the markets as well. And or surety, the contractual guarantee that an insurance firm will offset poor market performance in an investment per predetermined agreements of the insurance or annuity contract. And so how do I illustrate that? Well, let me show you what I would do with that. Nope, one too soon. So I'm going to take you to a particular chart that we use to show how we can use strategies to protect income, principal, or both. So now I'm going to minimize that and come over here. So this is a market history, for instance, for the Dow Jones from 1929 to 2022. So what we're looking at here is 94 years of performance. And if we look at the actual performance over the average rate of return for those 94 years, the Dow produced 6.93% per year. That was its average. But its actual was 5.13%, not 6.93%, almost 2% difference. And so when I ask people, why do you think that as a difference? It's not because of advisor fees. It's not because of fund fees. It's not because of taxes. It's not because of inflation. It's because of one simple point, and that is average return is simply taking the annual return times a number of years and then dividing it to create an average. Actual return has to deal with a concept that I've shared in the past called drawdown. And if you were on that, if you're part of that review when I was talking about that, it simply means this, that if a person invests $1 and that dollar, the market goes down 17%, that means at the end of that year, they have 83 cents in their account. In this example here, we'll drop down through these years because this is back during the Great Depression. So during that period of time, those 4 years, a $1 investment in the Dow Jones went down to 20 cents. That would be terrifying. But in 1933, that year, the market went up 67% almost. Now, the problem is that 67 cents is not based on the dollar. That 67 cents increase is based on 20 cents. So it went back up to 33 cents. Then it went up 4, went up to 35, went up almost 40%, went to 48 cents. And you can see the pattern. Actual rate of return during the same period of time that it was averaging 6.93%, because of trying to come back through drawdown, made the performance 5.13%. So now that's probability. That's clearly a good illustration of probability in the markets. But are there ways to fix that? And there are. There are ways to offset it. And so what I want to do is illustrate a couple of those ways to do that. We work with investments that provide barriers that mean that if they have a certain level of protection and that barrier is not broken, our clients get more of their money back or all of the money back. We also have buffers, which can protect against downturn as well to make it so clients don't lose something. So let me illustrate that. So suppose we said, well, we're going to click this right here. Okay, there we go. We're going to click this here, and there's a 0% floor on the investment. What you'll notice is that the investment went from 6.93% to 11.56%, simply meaning that whereas a 17% drop in 1929 meant that the investment would go to 83 cents, but if it had a limited floor protection of 0%, it meant that you would make $1. Your account wouldn't go down. It'd still be worth $1. And the same thing would happen here and here and here, so that when that happens at the end of that 4-year period of time, you still have $1. Now, you haven't made any money, true, but you didn't go down to 20 cents either. And then when you did have that 67% increase, your $1 went up to $1.67. And over that period of time, you can see the huge difference that while $1 invested in the Dow Jones from 1929 till today has grown to $110, which is awesome. With that simple item of creating a 0% loss, meaning you can't lose money, it went from 110 to 16,847. So now I get it. You'd say, well, Frank, wait a second. That can't be possible. Well, in some ways, I mean, what I just shared with you is possible, but nobody's going to do that for free. And so that's where a barrier note or a buffer note or some of the annuities, variable annuities that have buffers or barriers built into them, they can help make that happen. But for that, they have to do a couple of things. And so let's make it a little more realistic. For instance, they might put a cap in there, meaning that they're not going to let an investor have all the upside. So yes, they're going to protect against this downside, but they're going to say, well, we can't survive if we let you take no loss, but we give you all the upside. So for instance, they might put a cap on it. And that cap might be that they'll say, well, you know what? We'll do 20%. So what that means is instead of the investor getting all 66%, maybe they'll only get 20% of it. And so since they only get 20% of it, that means their dollar went from $1.67 after the cap was put on to $1.20. So they didn't get all of that, but then that way the barrier note or the investment company, the banking company, the insurance company could stay in business to keep doing this. Now, they're not going to do that for free either, because they're taking a huge amount of risk and they're trying to offset that. So what they're going to do is they're going to charge a fee. So let's say they charge a fee, we'll say 1.5%, which is a big fee, no doubt about it. But even with that, it changes the performance from 6.93, and even though that was a nicer number a moment ago, it's still 7.86%. So it means that after they protected the downside and they gave a percentage of the upside, the investor still had more money than they would have over the period of time. If we look at the actual, it was 7.54 during that same time frame. Now let's say that we could get somebody to do a cap of 30%. So with the 1.5%, that changes the numbers to 8.78 compared to 5.13, or 9.26 compared to the 6.93. Or let's say that instead of doing a cap, they said, look, we're not going to do the cap, but what we'll do is we'll do a participation. And so we'll do the participation at, say, 90%, meaning the investor can have 90% of the upside, whatever that is, and then the company, the investment firm or insurance firm, would get 10% of that to help cover their costs as well. So it goes from 6.93 to 8.9 is the average, and 5.13 is the actual to 8.36. So with this in mind, it's a way to have surety with either cap rates or participation rates and a fee that's going to be charged by the company who's taking that risk, and make it so that an investor can have a better opportunity for growth. And so when we're talking to clients about having more surety in their portfolio, they're saying things like, well, we want to be invested in the markets, but we're a little nervous about all the risk. Is there a way we can help minimize that risk? And utilizing certain types of products like the notes or the certain types of annuities that do that, you can help to accomplish that goal with barriers and buffers that give more surety to your portfolio. Now, somebody says, look, I'm not paying that fee. I don't blame them. I understand that. I'm willing to take all the risk. And so they say, you know, there are plenty of times in the market when it works out well, and that's back to probability. Nothing wrong with that. It's a great plan, but it's not going to be for everybody. And so for those investors who say, I'd like to have a little more surety in my investment strategies, this is a way we can do that with certain types of notes and certain types of annuities. Let me go back to our presentation here. And if you are asking questions or whatever, I'll be more than happy to go back through those, or we can talk about these individually. So now let's deal with the next issue, tax management. And the number one expenses I've shared last year when I was doing planning talks in some of our advisory reviews, number one expense of many Americans is taxes. And so when we look at taxes, trying to help minimize those expenses are an important and critical piece of trying to help clients grow money. Clients, and rightly so, are often worried about investor or advisor fees. I agree with that, don't have a problem with that discussion. But what I would say is taxes are significantly more of a concern than advisor fees. And what I would show you here is a chart I think many of you have seen before, but I'm just going to quickly go through it. Let's say that you had an IRA that was worth $750,000. So you get your statement and you look at it like, we got $750,000 in IRA. It's fantastic. We're very happy. But that's not really accurate because you have taxes that the IRS is anticipating. Let's say that the tax rate is 25%. So if the IRS were standing there looking at your IRA statement, they would say, well, no, you have 562,500. We have 187,500 of that. And they would not be wrong. Over your lifetime, when you pull money out, you're going to pay taxes to them. Over your lifetime, you'll pay taxes, but then if you haven't pulled all the money out by the time you pass away, the IRS is going to say, hey, we get part of that money too. And they're going to get part of that IRA money then through what's called the IRD tax, income with respect to decedent. So when we're looking at this, we're looking at this chart, and the reason this chart goes back to 1913 is because there was not a federal income tax in America until 1913. As I've said to you before, Abraham Lincoln, at the end of the Civil War, Congress instituted a federal income tax, but because the war ended, they stopped it. It wasn't until 1913 with Woodrow Wilson that he came in, he said, hey, look, bottom line is this, we'll need 7% from those people making over $500,000. That's those mean rich people, they can afford it. And we'll take 1% from people making 20,000. So that won't affect most people. So that'll be great. And that's all we'll ever need. The government will never need another dime. And then 4 years later, they were up to 15% on 2 million. And another year later, they're at 67% for those over 2 million. And then they're up to 77% for those at a million. And they start lowering the rates or lowering the amounts. but keeping the rates up there and so on. So when we're dealing with that, we're looking at taxes not just for today, but also for the future, because lowering taxes today is absolutely critical, but thinking about the future is essential for how you're going to grow family wealth. Because when we're looking at these tax dollars, one of the things to realize is that maybe this is the bracket you're at now, but the IRS or Congress is fairly comfortable with raising rates. And if you look at the debt clock today, we're at $34 trillion of debt. You think about all of the expenses the government has. You think about interest rates going up. It seems pretty reasonable that they are going to have to raise rates again. As a matter of fact, it'd be fair to say that we were back at 28% in 1989, and we keep moving that up. They keep adjusting who has to pay and how it works. But it seems realistic that we will end up having a rate increase somewhere down the road. If that's the case, and your IRA is still worth $750,000, but the tax rates go up to, say, 35%, the IRS says, oh, no, sorry, your account's 487, ours is 262. They didn't put any money in there, but they're going to get 262,000 because you got to tax deduct what you put into it. So this is where Roth conversion comes in as one strategy for helping to minimize taxes. And so looking at how to handle investment accounts and to do so in a way that creates the best benefit for clients. When we take a look at the allocation mix, we look at, I'm going to jump here, to the common characteristics of taxable accounts, tax deferred accounts, or what I call tax postponed, and tax advantaged accounts. The reason I call it tax postponed is because you are paying tax somewhere down the road. You're postponing the tax itself, but you're also postponing the calculation. Like I showed a moment ago, if tax rates go up, you may end up paying more than what you thought you were going to. So doing some things today to get taxable money or tax deferred money, we'll call it tax postponed, into tax advantage is essential if you're trying to make sure that you get to keep more money on your side of the balance sheet and less going to the IRS. Let me shrink that, I'll come back to that. So when we take a look at how to handle this money, we want to be looking at the best strategies. That's why in the last 4 months of the year, we're taking a look at not only current tax situations, how to reduce your tax bill, but also keeping an eye on the future to make sure that we give no more to the IRS than we have to. So in our planning software, one of the things it pulls out for us is what the anticipated tax bill for an investor, taxpayer would be. And so in this example from one of our model situations, this person is looking at taxes over the coming years. They're not a huge tax bill, 10,000 and so on, but over their lifetime, that tax bill is a cumulative effect up to age 100 of $573,941. Now you might say, well, I'm not going to live to 100 years of age. Fair enough, you might not, but if we bring it back to an earlier time, we can calculate that for you as well. But no matter what, whether it's $250,000, $500,000, $750,000, that's a lot of money to give to the IRS if you don't have to. And so having a plan in place can help fix that. One of the things that we can take a look at is to do a planning strategy called a Roth conversion. And that's to take a look at where a client's tax liability is going to be versus what the next tax bracket is, and use this space in here to maybe start doing Roth conversions so that while they're paying a little more tax, they're not bumping up into the next tax bracket. And so in this example I just showed you, the way it worked for this particular situation is that the cumulative tax was at 573, almost 74,000. And what would be left to their heirs and loved ones would be a little less than 3 million. By doing a Roth conversion of that money, meaning that we took some of that money in and moved it from tax postponed to tax advantaged and did it up to the point of their next tax bracket, we lowered their tax bill only about 25, 30,000 on that, which means they didn't pay a lot of taxes in the conversion, but we still saved some tax money there. But look what happened to the portfolio. It went from a little under 3 million to a little over 4 million. And the reason is simple. If a client says, hey, I need to pull out, we'll call it $10,000. They say, I got to pull out $10,000. We got to pay taxes on that. So we'll say their tax bracket's 20%. So they got to pull out 12,000 to cover the taxes due. But because they're pulling an extra 2,000, we got to pull out some more. So they might pull out $2,500 or $2,700. So they have 10,000 left in their hands. Once it's in that Roth IRA, they say, I want 10,000. We pull out 10,000. There's no additional taxes. So that money means they get to keep that extra $2,000 to $3,000 for taxes on that $10,000 withdrawal in their portfolio, growing for them for 5, 10, 15, 20 years. You do that enough years, that's going to have some meaningful impact on your future tax bill as well as your future investment growth. I don't know if this is me or if this is GoToMeeting. Or GoToWebinar. We're going to find out here, but so sorry that's running a little slower tonight. All right, taxes. Not only did we take a look at the taxes that a client might have to pay year over year over year, and then the cumulative effect of that, the fact is in the same situation with I mentioned IRD, income with respect to decedent, particular client, even after paying $500,000 in taxes, the IRS was still going to expect another $133,000 in taxes as well. And on a side note, client only had a will in place, but not a trust. And so their probate expenses were going to be roughly another $107,000. So by considering a Roth conversion strategy as well as a revocable trust, and I'm not an attorney, I'm not giving legal advice, but just looking at what that would do to the probate cost. The utilizing a Roth conversion strategy as well as the revocable trust solution wiped out all those taxes and meant that the whole 1.3 million actually ended up going to the charity or family or loved ones that they wanted to receive that money. So it reduced taxes significantly. It made more money available for family and for people they love and care about, and it disinherited the IRS in the process. So using these planning tools, especially understanding the importance of the right kind of investment strategies, can make a significant difference in a client's overall wealth during their lifetime and what they transfer to family at the end of their life. So now we've talked about cash reserve needs, we've talked about growth or income to growth ratio, we've talked about tax management. Now let's take a look at risk tolerance. One of the tools that we use is a tool formerly called Riskalyze, now it's called Nitrogen, and it tests clients' portfolios. Portfolios, investments they have with us and investments they have outside of us can be applied to this strategy. And when we take the test, or when a client does a self-assessment, they're going to score between 1 and 99. 99 means they are a full-on risk taker. Number 1 means they're a full-on risk avoider. In this particular example, this client is a 56, meaning they're in the upper 50 percentile, but not very far into the risk management. With a $533,000 portfolio, that means that during with a historical average of 95% percentile expectancy, they could have a performance of about 18%, almost 19% in a good 6-month period of time, or it could have a bad downturn, about 11.3%. What we're looking at here is their upside is significantly better than their downside, and that's what we're looking for in a portfolio. And we can see that with that, now nobody's going to be excited about this, but their portfolio, if it went down 11.3% during that 6-month period of time, it's going to be down about $60,000. But if it goes up 18%, it's going to be up there around $100,000 in gain. And the nice thing about that is understanding in dollar terms what that means to us, because people, they have this mindset that, oh, 10% down isn't that big a deal, but when they see their statement is down, $50,000 or $60,000, that can be pretty disconcerting, especially if you're retired. And so understanding what the risk modeling of your investment, whether it's things that we're doing for you or 401k plans you have outside of us or whatever, understanding that and being able to say, what's the risk tolerance applied to my portfolio versus my own personal risk tolerance desire. So let's say this person has a risk number of 56, but one of their accounts has a risk profile on it of 84. There needs to be a conversation about, well, how much risk do I really want to take? What would that be like? Am I good with that, or do I need to make that portfolio a little more conservative? Another thing that this software will do for us is it'll help us take a look at a client's portfolio and compare it to, well, what would happen if we had the bull market like we did in 2013, or a bear market like we did in 2008? What would the performance have looked like? How much would it have gone down or up based on that? What if it's the financial crisis again that we experienced in the whole period of time for 2007 to 2011? What about if we had an interest rate spike, about an interest one, and in this case, 1 1/3? What would that do to a portfolio? And it helps clients understand in numerical and dollar amounts, not just percentage, what they're looking at. So then they can say, yeah, I wouldn't like it, but I'm okay with it. I wouldn't lose sleep over that. And so the bottom line is understanding and applying your risk tolerance to your investment portfolio is important for your overall success as an investor. Because when clients have the risk modeling in place and they understand the reward potential of their portfolio, they're able to say, yes, this makes sense, I'm good with this. Versus when things don't happen like they expect them to, if their expectations because of loss or not enough gain aren't met, it creates problems. And we're trying to help them avoid that by stress testing the portfolios they have with us and outside of us through their financial planning modeling to what their risk tolerance number is. And that strategy with nitrogen, formerly Riskalyze, is a way we help clients understand that. Understanding that risk works simply like this. Again, back to our 3 buckets here. For clients that have a higher risk portfolio, that means we're going to have a lot more volatility. We'll have higher return potential, but also higher chance of loss. For those with more of a moderate risk, we're going to have some limited protection options. We're going to have more moderate volatility, some limited liquidity, and a moderate return potential. And then finally, for no or low risk, we'll have guaranteed returns, no loss provisions, usually high liquidity, and then lower return potential. So what we might say is, in terms of today's numbers, this might be 4 to 6%, this might be 7 to 9%, and this might be 10% plus. But then also the risk measurement of what a client could be expected to experience if the markets went down, that's also another important piece of this. That's why we measure the risk tolerance. So what we're able to do is to take this software and then say, this is not only what your risk number is, but this is how your portfolio is set up versus how you'd like it to be set up. And I'll probably give a little bit of that example in next month's presentation or review. So these items, they all fit together with the 3 phases of your financial journey. Because again, when we start out, we're climbing the mountain, we're accumulating assets, we're working towards that time when we're going to plant our flag and say, I'm out of here. I am retiring or redirecting. During this time, when we have times where the market falls, we don't like it, but because we have a job and we have income coming in, it's not the end of the world, but we try to minimize that. I'm talking about us as individuals, not advisors, us as people. Because we have our income coming in, it's annoying, it's bothersome, but we're okay. We get to the other side of the mountain though, and we start decumulating. We start pulling money from our investments and the market falls. Now we're having to pull out more money because the market fell. There are really significant differences in the investment mentality of accumulators versus decumulators. Yet oftentimes people come into the retirement modeling thinking like this, not realizing that when the first serious market downturn happens, it's going to really mess with them. That kind of comes back up here to sequence of return risk, which is a really key point. If in the first 5 years of your retirement, the market falls 2 or 3 of those years, that can be devastating. It can even make it so that your retirement plan won't last as long as you do. So minimizing risk here during these first 5 to 7 years is essential to making sure that clients can have confidence that their retirement plan will be able to meet their long-term needs. And then coming down here to end of life risk, where we have the expenses of health care, the expenses of long-term care, the end of life issues with incapacitation and incompetency, making sure those are well planned for can make it so that when the time comes that we do go home to be with the Lord, we are then ready to transfer whatever is left wisely to our heirs through good estate planning and strategies that can make sure everybody is receiving what they're supposed to, and to make sure that the taxes, fees, and expenses are as low as they can be. That's all part of this process for helping through the 3 phases of your financial journey while maintaining your desired return on life. Not just return on investment or return on assets, but return on life, so that as you or I take our last few breaths of air on this planet, we won't be thinking about how much we have, but how well we did with what we have, because that's really the goal here. Those 5 investment strategies I just shared with you, those are designed to help make it possible so that when you start looking at your return on life, as I've shared before, the software we provide for clients gives you the ability to start re-examining how you want your life to look forward as you transition from the accumulation phase to the decumulation phase, and begin thinking about, what am I going to do? I had 40 or 50 hours each week. I was doing this thing where I was trading time for dollars. Now I've got all that time. What am I going to do? What do I want to do that will help me envision that life that I want to have? And so this is another part of it, not just the facts and figures, but the feelings and desires that our clients have, that you have, to make the most of what you have during your lifetime, even up to the end of your lifetime. The way we would do this is we think in terms of creating and growing wealth with your investment strategies, protecting and preserving wealth with tax, trust, and insurance management solutions, and doing so with the financial plan in place that helps you determine the direction and the destination you're headed at. It's not just about having the facts and figures of investments, insurance, and planning in place, but also your personal readiness, because the unique possibilities that are your life have to be thought about to say, you know what, maybe this is not the time for me to retire. Maybe financially we're ready for it, but I just don't want to. I had 2 conversations with people today where they were both saying, yeah, I think I want to retire, but I'm just not sure that I'm ready to yet. The finances look good, but I think I might want to work a few more years. That's what I mean by personal readiness, to make sure that you're ready to do it so that you can then have that exciting silver age, golden age lifestyle that you want. So that's why we take all this time with the fiduciary wealth advisory mindset to help make it so that you can achieve these goals with confidence and peace and enjoyment at the same time. As I've been talking, so this is that financial dashboard we use to do a lot of the planning. This dashboard helps, we provide this to clients so that it helps you to be able to look at our performance for the investments we call AUM, assets under management, that we're managing for you. This, Riskalyze, now called Nitrogen, is the self-assessment you can do to determine where you are with risk tolerance personally and how your investments match up to that. And this is how we help tie together your return on life, looking at bucket list items as well as transitional items to get you through here to wherever you want to be. And these are available to you on our website. You just simply go right up here and click on login, and that will get you to these 4 apps. If you do not have logins there, you can't get in. I mean, you can get up here, but you can't get down in here. Just let us know, and we'll be happy to get you those logins so you can do that. Hopefully, you are checking out our weekly updates. We're taking time each week to give this information to you. Sometimes it's showing up through Facebook, sometimes through Twitter, sometimes through LinkedIn, sometimes through all 3. Sometimes it's showing up in your email. But in between each of these wealth advisory reviews, we're trying to give you updated information so you can just be aware of what's going on. And we have multiple sources we draw information from. So it's not just we pull from one place that agrees with us. We pull from places that maybe I'm not so sure I agree with, but I want to hear what they have to say so that I don't have that confirmation bias I was talking about last month. So as we're planning, I hope you're checking out our weekly updates, because they're there for you and available to help you understand what we're doing and understand where you are. And then also, if you have questions about it, to say, hey, Frank, can you explain this to me? So all of the tools we provide you, the financial dashboard, the report suites that come through the financial dashboard, the electronic vault, which you can have electronic document storage that's bank grade encryption, 256 key, planning and wealth management reviews every 4 months for the planning clients, the beneficiary estate and income tax review, risk management assessments for you on insurance programs that you have in all of your wealth planning needs, return on life, an update of your bucket list and transitional list, and then these reviews. These are all part of what we're trying to do to make it so that our clients can be as up to date and as comfortable in the know about what they need to be able to make wise decisions. And there's more things that are on this list that we provide. So hopefully you're getting to take advantage of some of these items. So here's my thoughts for today. One, not on this list, but so sorry that the tech has been a mess here. I'm going to do some things both with whether we're going to stay with GoToWebinar or what we're going to do, because this is crazy. Even, I don't know if you've noticed, I don't know if you can see, but every once in a while I have this spinning beach ball of death up here where it just keeps spinning. I have no idea why that's doing it, because it shouldn't be. So we're going to work on that. So I'm so sorry that the review didn't go along as fast or as smooth as I would like for it to. Outside of that, though, keep monitoring economic and market conditions for opportunities and threats. I can tell you that even this last month, I had a couple of clients that reached out and said, hey, have you looked at this? Have you thought about this? A couple of the ideas, I said, let me do some checking on that for you. And we thought they were really good. So you and our office here, we're a team. And so if you have ideas, there's no idea that's dumb. Bring it to us. Let us hear. If we've heard about it, we'll share with you what we know. And if we haven't, we're going to do some research and get back to you and say, hey, you know what? Great idea. Or, hey, let me tell you why I think it might not be the best idea, so that you can say, well, I still want to do it, or no, that makes sense. We're a team. Second thing, understanding your cash reserve and investment income needs is essential for our team to help your family. Next, recognizing and utilizing your risk tolerance needs helps us help you become a more successful investor. Utilizing intelligent TFE, taxes, fees, and expense management strategies in your investment portfolio is essential for growing, protecting, and preserving your family's wealth. Identifying your investment policy is crucial for making your investment portfolio more effective in meeting your family's financial goals. And identifying your expectations with investments and communication with our wealth management team is critical for your financial satisfaction. We don't want you sitting in the dark wondering what we're doing. We want to know if you have a question, we're here for you, and we want to do everything we can to get you answers. And finally, fiduciary wealth advisory requires a dynamic financial planning strategy, which is what I hope you see we're doing, because that's what we're killing ourselves to do for you. That strategy is to help you and your family manage wealth wisely in today's complex economic environment. So I'm going to turn it over here in a second and see if there's any questions. Our next advisory review is April 16th, where we're going to continue this discussion. I'll probably spend more time on the last 5 investment strategies to help you understand why we do them and why we think they're critical, and help you understand when I say certain things what we're really referring to. So we talked about the market. I reviewed the first 5 items in our investment allocation blueprint strategy, gave you my final thoughts, answered your questions. I hope now, maybe when I talk about your cash reserve needs, you understand part of what we're trying to do a little bit better, or your income to growth ratio. That might make a little more sense to some of you. Probability versus surety investment strategies, investment tax management planning to make sure that we're not giving any more to the IRS than is legally or morally required or ethically required. And then finally, your risk tolerance, the investment solutions for that to make sure everything is on target with what you need. So hopefully this helped with a little bit of that as well. If you would like to invite some friends, you're welcome to do so. The Wealth Advisory Review is open to anybody. We are working hard to get these up on the website. I think we have a couple of months left that we're trying to get up there. We've really been struggling with time and people being out sick and so on, but we're getting those up there. But if you have a desire to hand one to one of your friends, just let us know. We'll be happy to get that to them. Or better yet, just let Kayla know, and we'll be happy to invite them so they can attend. And that is all there is for today. And I'm not bad on time over. Let's see about questions. So, don't see any questions. Okay. Oh, there's one. Hey, Kevin. At the beginning, he was telling me stuff I wasn't seeing it, so to figure out how to get that to pop up. Let's see. And is there any chats? Oh, just Stephanie and Brent tell me they can't see anything. So, okay. All right, my friends. That's all I have for today. I am going to head home. Jane's going to be making salmon with a glaze on it, she tells me, a guava glaze. So I'm looking forward to trying that. So if you have any questions, again, we're here for you. Please do not hesitate to let us know. And I look forward to talking to you all very soon at your next meeting, or if you have questions or whatever, we're always here for you. So I'm just going to bid a fond adieu and tell you I love you, and have a great evening and a wonderful week. Thank you so much.